Hello and welcome to Econoday Unplugged. It's Tuesday, the 23rd of April, 2019. William Shakespeare would have been 455 today, and talking of great writers, Mark Pender, no doubt quill in hand, is poised stateside. And I'm Jeremy Hawkins here in London. Now, the Swiss Central Bank must be a little happier now that the Swiss franc has lost best part of 3% now of its value against the euro this month. That's its steepest fall since July 2017 and a sign that investor appetite for safe haven instruments is on the wane. However, if this shift to risk on is to continue, the economic data, particularly out of China and the US, will probably have to at least live up to expectations. So while Good Friday has been and gone, this Friday we get our first look at first quarter US GDP. But will it be good news for the US economy? Mr. Pender, over to you.
It will probably definitely be good news if, at least at the headline level, and it may be getting a boost from inventory growth. Whether or not that's a plus is uncertain. But exports look to have been improved sharply this quarter, even though we only have 2 of the months in. March is still out. And so there could be revisions to that. I think that the consumer piece to this puzzle, however, is a little bit unknown. The Econoday consensus for this is 1.1% annual growth, which is down, which would be down from 2.5% in the fourth quarter, which was a surprise given how weak December retail sales were. So that I think is a wild card for the report. And again, we'll see how the consumer is doing. Residential investment looked to be very weak. Once again, all 4 quarters last year, residential investment was down, and the housing sector, that was really the definitive measuring stick for how weak housing was last year. But we had mortgage rates really coming down sharply from the 4.7, 4.6 level to the 4.2, 4.3 level so far this year. And it really showed in today's new home sales report, which easily exceeded expectations. And together with the existing home sales report on yesterday, Monday, which came down in March, but it followed a gigantic surge in February. So putting all these housing things together, mortgage rates really do have a very strong effect on demand for housing.
Quick question on your housing market, if I can. Certainly, sure. If you look at the UK, there's our home ownership is a pretty big issue as far as UK consumers concerned, and so there tends to be a pretty strong correlation between what's going on in the housing market and the overall level of consumer spending. Is that true your side as well?
Yes, housing is a deceptively important. It's not really that deceptive. It's almost invisible in recent Federal Reserve discussions. They don't really point to it in their statements directly, and it's very much of a side issue. It's a little bit mysterious to me, but home prices are a very important source of wealth. And here, appreciation has definitely been slowing. We also had the FHFA price index come out today, and it was well below all expectations. Year-on-year growth now is in the 5% area. This is down from 7%. It's still growing, so it's still positive. But this is the weakest appreciation in 4 years. And Case-Shiller, which is another report that'll be updated next week, they're at a 6.5-year low in appreciation. So this is it's not really a negative. It's just a diminishing positive for the consumer wherewithal. But I want to get back to your Swiss franc thing, and we've been talking about the global economic slowdown. And yesterday or Monday, we had from China, we had the Politburo over the weekend was talking about structural deleveraging. So, and this is a sign that maybe they're not going to need to stimulate the economy as much as they thought. And we see this in the Swiss franc. We haven't really seen it very much in U.S. Treasuries. The yields have come up a little bit, but it hasn't been a gigantic signal that safe haven demand is down. But that's interesting that you picked out the franc. Any other thoughts on that? Any other signals?
Well, so I mean, Frank, I guess when you're looking for some, sort of safe haven investment instruments across Europe, the Swissy tends to stand head and shoulders above everything else, certainly as far as the currency market's concerned anyway. And we know that the National Bank has been particularly concerned about the strength of its currency because inflation is so low in Switzerland and it's desperately trying to get it back up towards the 2% mark. A weaker currency is clearly one of those factors which could help to propel import prices and hence ultimately consumer prices as well. But more generally, I think at a time when we still have very sluggish Eurozone growth, the flash PMIs we had out for April last week were again very disappointing and really hinting at no pickup in economic momentum, at least at the start of the second quarter. So in contrast to the US, where by and large, as you've talked about in previous weeks, growth is still doing okay. In Europe, it remains sluggish. And yet we've seen bond yields starting to move up a little bit as far as the safe haven currencies like Swiss franc and in particular the German Bund market, which I suppose from the bond side is the number one investment safe haven investment vehicle, and the more peripheral currencies such as Italy, Greece, particularly the Portuguese bond market as well, they've been outperforming. So I think but you can't take this too far by any means. But I think just looking at the overall constellation of the way asset prices have been moving in Europe over the course of the last week or so, there does appear to have been some sort of shift away from growing concerns that, oh look, the global economy is really slowing down now, the weaker economy is going to be hit really badly, the more peripheral currencies could struggle. That has certainly been tempered. It may not be completely gone, but it certainly seems to be tempered to some extent.
Well, now you were talking. Oh, I'm sorry, but we were talking about Italy now being on the cusp or in technical recession. How are they doing now? They're having an election coming up, and I was kind of surprised to hear that their demand for their bonds is improving.
Well, Italy's doing a little bit better at the moment. As you mentioned, technical recession arrived at the back end of last year. We don't have first quarter GDP out of Italy yet. We won't for a little while. They tend to be, national accounts in Europe tend to be somewhat lagging compared to what you have on your side. But the early indications are that probably first quarter is going to see, I suspect, a return to positive growth, but it's only going to be very minor. In terms of sort of the big elections over here, we've got the Spanish elections taking place on Sunday.
Oh, that's right, Spain, yes.
Yeah, so that's it's politically it's still very unstable over there. The Catalan issue hasn't really been fully resolved. This is going to be yet another election as far as Spain is concerned. It seems to be one almost every year now. This is going to be their third election in the last 4 years. And to be honest, it's a big unknown what's going to happen there. I think in terms of the euro, and we're talking at the moment what a strong dollar environment and a fairly weak euro one, what investors will be concerned about will be just how well the far right Vox, that's VOX party, performs. This particular grouping has done particularly well over the course of the last few months in the opinion polls. Some are suggesting they could get as much as 10% of the votes now. And were that to be the case, they could potentially be part of the new incoming government. And of course, more broadly, the concern is that there is still this tendency towards populism or nationalism, call it what you will, across Europe. And with these key European parliamentary elections taking place towards the back end of May, what we see coming out of Spain could be regarded as a litmus test of what we're going to see there. And any kind of shift in that direction for the European Parliament as a whole, that would certainly be a negative as far as the euro goes.
And how's German manufacturing doing now?
German manufacturing is, I guess, really one of the biggest sort of thorns in the side of the ECB. I just mentioned that the flash April PMIs we had out from the Eurozone last week. Well, it came in just in terms of the numbers, the overall Eurozone composite output index, so that the proxy for overall GDP, that was just 51.3. So on the right side of 50, but not by much, and it was down from last time. But within that is only the growth was really only due to services, which was 52.5. Manufacturing PMI, or the flash PMI for the Eurozone, was 48.1. So below 50. And why is it so weak? Well, it's really down to Germany. The German index was just 44.5. So really in recession territory still. So although there have been some, the odd month where German industry looks to have done okay, the underlying trends, and I think we touched on last week, the forward-looking indicators like business confidence in the year ahead and orders, they're still going the wrong way.
Yeah, a 44 reading on a diffusion index with 50 being neutral is a very weak reading. But we've seen that in Europe, and we've seen that here in the PMIs, which bring out services. The bulk of economic data statistically is manufacturing, but we have these services reports. And here in the U.S., we really only have a couple of them: the ISM non-manufacturing and market economics PMI services. The latest one from Market showed, it was the same kind of thing going on here, that there was a shift, what manufacturing was losing because downturn in global trade, services were making up for. We saw that unravel in the latest sample for April, at least just 1 month from one sample. But that was an interesting shift. Now, how long can a service economy, a domestic demand, make up for a loss in growth on the manufacturing side was a question, and I guess it still is a question, and it's an interesting.
I think it's a very pertinent question. I think. Yeah, because I think certainly, the thing about Germany is that compared to pretty well the rest of Europe, its manufacturing base is still hugely important to how the overall economy itself performs. And for Germany, just going back to their numbers, these PMI numbers, we talked about 44.5 on the manufacturing index. Well, the services side, that actually improved a little bit. That went up from 55.4 in March to 55.6. So again, okay, it's not a big increase, but in terms of 55.6 reading suggests we had decent economic momentum taking place in German services. But I think it's hard to believe that we can see services continue to grow at that kind of rate at a time when the core of the economy, the manufacturing base in Germany, still appears to be shrinking. So it's got to be something to look at.
Conceptually, it's very interesting because, we've had Brexit and we've had the Trump administration. We've had this protectionism, and it's not sold as the idea that it's going to lower, aggregate demand. It's going to lower economic growth. That's not, one of the arguments. That's what one of the risks could be. But if it somehow stimulates domestic demand, that somehow could make up for it. I don't know. This, of course, goes against the whole idea for generations of economics and cross-border agreements and those kinds of things that are supposed to raise everybody's, the tide and all that stuff. But maybe this is going to be playing out in some kind of conceptual development.
Maybe. And certainly, I think people tend to, when they're looking at exports more often than not, they're looking at just exports of goods. But for some countries, UK being a big one, services are even more important. I guess that's why, to some extent, the global economic indicators and particular performance, as we said, of US and China are so important. I think one reason, going back to where we came in on this sort of this risk on, or move towards perhaps a sort of a risk on, comes down to the China GDP numbers we had out last week. They show growth holding up there. Was it 6.4%? That was stronger than expected, and certainly we had a decent PMI out there as well, and it's just given that little bit of hope that, well, perhaps worries about China might have been somewhat overblown. Remains to be seen, of course, as we all know. 1 month or one swallow does not a summer make. But
that's another example. China's trying to stimulate its own domestic demand. It's been trying to rely less on exports. How long can this go on? Is this a fundamental shift in how people think of global growth?
Maybe. I think one of the issues for China, I think some of the talk coming out at the weekend was that, well, look, perhaps our economy is not quite as weak as we thought. Therefore, we don't have to fiscally reflate as much as we previously, considered we'd need to. So it remains to be seen at the moment, but I think it's a very fair question.
We've been in a thankful zone of no Brexit talk for a couple of weeks, but let's not. I like the punishment. Go ahead, fill us in.
I can almost hear all our listeners just tuning out as soon as you mention the magic word. Well, the good news about Brexit is there's not a lot to talk about at the moment. The UK Parliament, the House of Commons, that reopened after its Easter break, which means that cross-party talks will resume as of today. But in terms of where they left it just before Easter, I think as people are well aware, there is no sign of any kind of compromise coming out between a Conservative Party, the government, and the opposition Labour Party. So it's still anyone's guess as what's going to happen. As things currently stand, just to remind people, the end deadline is October the 31st. If there's nothing agreed by then the UK will fall out of the EU without a trade deal. Also, if we don't, the UK doesn't agree to participate in the European elections in May, then we'll be forced out by June the 1st.
Well, now May's coming right up. What are you guys going to do?
Well, I think it's extremely hard, I think, to see. Basically, it's still the case that no one in the UK and indeed in Europe wants to see a no-deal Brexit. So I think although the government over here does not see any point in being part of the European parliamentary elections, because in theory, in a matter of months' time, or perhaps a year or so time, we won't be part of the European Union. We're going to be forced to be part of it. So I think we will just simply say, well, OK, we'll continue to send, MPs to the European Parliament, because if we don't do that and we're still part of the European Union, then the European Parliament doesn't have any justification. Its constitution won't allow it to operate unless all members of the EU actually send across members of Parliament.
So it then looks like the October deadline is going to be the meaningful deadline.
I think so. I mean, clearly, who knows with Brexit? It's anyone's guess. But I think at this stage, where financial markets are trading, they're working. Well, look, we've got 6 months now that we don't have to worry too much about Brexit before we get to the next cliff edge.
And will sterling be going down now, or how will sterling be behaving?
Well, it's a good question, because I think sterling is still basically right. What's going on with Brexit? And in terms of Brexit at the moment, because of the Easter recess and so on, there's nothing going on. And I mean, if you look at the volatility in the pound, it's close, was it 2 years low, I think, now, because people simply don't know what to do with it. But, and it's worth mentioning, talking about demand and so on, we had the UK retail sales figures out last week for the back end of the first quarter, and they were up 1.1% on the month. Now, that is a big number. And bear in mind, these are volumes, so they don't have inflation in there. This is actually the number of items being bought. And that alone is going to add about 0.1 percentage points to first quarter GDP growth. Now, the B of E, the Bank of England, is still operating at the moment with a tightening bias. I mean, it can't do anything because of all the Brexit uncertainty. But it does kind of suggest that if we were to see somehow a short-term favourable solution to Brexit, which the EU would accept, and the UK could leave the EU effectively whenever it wanted to with a deal, and the Bank of England might actually respond by putting interest rates up. So at the moment, the UK economy, notwithstanding all the Brexit uncertainty, which is supposed to be tipping us down the proverbial pan, the UK economy actually appears to be holding up pretty well. Right, OK, let's quickly round this off before we talk for too long. Just in terms of central bank meetings this week, we'll have the Bank of Canada. That'll be tomorrow, Wednesday. Nothing is expected out of that. We'll also get the Bank of Japan meeting. They'll be concluding their meeting on Thursday this week. Again, no changes in policy there, or keep an eye out for, because they'll be updating their economic projections. And chances are they're still going to suggest that they're not going to get close to this 2% inflation target. And just quickly sticking with Japan, so there may not be much volatility coming out the BOJ meeting, but we should mention that Golden Week in Japan kicks off next week. So exchanges should be closed there between April the 27th right through to May the 6th. And that's a reflection of the combination of the traditional holidays and the 1st of May accession of a new emperor. And that's going to make the longest market closure since the end of the Second World War. So liquidity out there will be in short supply. And for people who remember, the last time we saw a similar sort of shortage or potential shortage was the New Year holidays last year. And that's when we saw the so-called flash crash. When Japan was shut for the last day of the New Year break, and we saw the Australian dollar and the Turkish lira absolutely dumped against the Japanese yen. So it may or may not happen in similar sort of vein next week, but it's something to be alert to, because it does offer the potential thin trading conditions, particularly with all this algorithmic trading happening now. It does offer the opportunity for some of these currencies to move extremely violently. OK, well, I guess that's probably enough of the volatility there, and indeed enough volatility from us. So on behalf of Mark and myself, thanks as always for listening, and we'll be back again next week. Bye for now.